Markets are crashing today on the back of a 25 basis point cut by the Federal Reserve. The S&P 500 is down 3%. The Nasdaq is down almost 4%. The Dow Jones is continuing its 10th day losing streak, the longest losing streak since 1978. Gold's down 2%. Bitcoin is down more than 5%. The dollar rallied more than 1% intraday, which is a huge move for the DXY. And the 10-year yield rallied as well. What is going on? Here's what Jerome Powell had to say in his opening statement.
The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments.
Well, it was already anticipated that the Fed would cut by 25 basis points, so why are markets crashing? We're going to find out what's next for markets, monetary policy, and the economy and inflation with the next guest, Dr. Komal Sri-Kumar. He is the president of Sri-Kumar Global Strategies and a senior fellow at the Milken Institute. He also used to be a member of the alumni board of Columbia University's Graduate School of Arts and Sciences. Sri, welcome to the show. Good to see you.
David, thank you for having me, and it's great to be with you.
Sri, let's start by looking at the FOMC press conference from today. I'm going to play for you a few key highlights, starting with this one. Take a listen, please.
Gina Smialik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does it pause next month?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability. We see the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher.
Sri, this is the worst single-day sell-off in equity in months. Clearly, the markets did not anticipate what happened today. What was the surprise?
The big surprise was, until now, you have had Jerome Powell, who was more seen as a big supporter of the stock market, David. So in other words, if there is a correction, he will step in and he will say favorable things and cause a rally to go on again. I have been critical of him because of the fact that he's not focused on just inflation. He's focused really on the stock market, even though he doesn't say so. And today's developments, his press conference and the Fed decision, essentially told the markets that he may not be there to support them in the future. That is a big difference in the last 4 years. That has not happened since COVID began. And that is, I think, the major reason why the stocks backed off so much today.
Why have you been critical of Powell's policies?
I have been critical of it because I think, so many. Let me count the ways. Let me start with the first one. There is no principle that guides their policies. I call it seat of the pants decision making. They decide, they come here and they look at the latest numbers and they say this is what they want to do. Look at what happened in March of 2020. COVID came and he immediately cut interest rates to zero. And from 2020 beginning to the beginning of 2022, the Federal Reserve's balance sheet had doubled. David, keep in mind at the beginning of 2020, the balance sheet was already 5 times where it was in 2008 during the Lehman Brothers crisis. And so after having increased by 5 times, they doubled yet again from $4 trillion to $9 trillion. To me, that is irresponsible. Fiscal policy was very expansionary. We had $900 billion of spending in the last months of the Trump administration, $1.9 trillion again in the first months of the Biden administration. And then you had this expansionary policy. When he was asked about it, he said, well, we do not look at fiscal policy. We look at only monetary policy. As a student of monetary policy, such as myself, that is sheer nonsense. You do not conduct monetary policy by saying, I'm going to ignore what happens on the fiscal side. So those are some of the reasons. Depending on whether we have the full day or the full week, we can talk a lot more about what else the Fed did that was wrong.
So this is now the updated expectations for the Fed Watch tool. So as you can see here, there's a 91% chance of no cut by January. So the markets are now, after today's conference, expecting the Fed to stay put. Do you think that was what's caused the massive drawdown in equities today? Because markets were expecting initially more cuts in 2025.
Markets were not expecting cuts in 2025 before today, because the news has been very prevalent that the Fed would likely cut interest rates the last time now in December, and would indicate that there would be a pause in 2025. So that's exactly what happened, what was expected. What is the difference? The difference was he admitted that inflation is not coming down fast enough to the Fed's liking. He then talked about he could not say when there would be rate cuts and how many times, even though they had penciled in 2 rate cuts in 2025. So those were the reasons. So the market essentially believes that the rate cuts are highly uncertain. Look at the NASDAQ index, which is most interest rate sensitive, and it fell the most in percentage terms. And that is also a judgment on what is happening with Powell, and that's what is happening here. What do I think? I don't believe that the Fed is going to cut interest rates at all in 2025. We are finished. This is it. Next move is either remain the same or have an increase in the interest rate because inflation perks up significantly in the first half of 2025.
If you want to know more about what was discussed at the FOMC meeting today and what Powell said at the meeting, check out Ground News, today's sponsor. Ground News is a fantastic aggregator. It brings together sources from across the internet and has unique features like a bias distribution, which shows you roughly how many articles covering a story are left-leaning, right-leaning, or center-leaning on the political spectrum. It also has a ownership meter, which shows you what percentage of the stories are owned by independent media sources and or conglomerates. If you want to check out Ground News today, use my link, groundnews.com/David Lin in the description down below, or scan the QR code here to get your Vantage plan today. 50% off, under $5 a month subscription. A great deal. Honestly, a great resource. Check out Ground News. Let's talk about inflation now. You have written on your Substack that interest rate cuts will inevitably lead to an acceleration in inflation. Such discussion is of more than an academic interest. A pickup in inflation would lead to higher yields on long-dated Treasury and mortgages and slow economic growth. We'll talk about tariffs in just a minute, but do you think that the Fed's policy of cutting rates 50 basis points in September and then subsequently 25 basis points in later meetings, is that enough to reignite inflation in 2025?
Let's see, first of all, what it has done to bond yields. The 10-year yield from just 2 days before the first rate cut, September 16th was a Monday. It was 2 days before the Fed cut by 50 basis points. Compared with September 16th, today we are about 90 basis points higher than where we were. So in other words, if the Fed thought it was stimulating the economy by cutting the federal funds rate, it has ended up doing the opposite. And I think in the future, there is not going to be an escape from it. If you want to develop economic growth, if you want to stimulate it, you want to have a reasonable and very predictable monetary policy. And that's simply what we don't have. The markets are pushing up the bond yields because the markets are afraid of the inflation pickup.
What is your outlook on inflation? And then I'll play for you a clip on inflation that the FOMC discussed.
I'm going to assume in the Trump administration, which begins January 20th, there is going to be at least some increase in tariffs, starting with Canada and Mexico at first. China is again a major target. And even if he does not increase by as much as he threatened, there is going to be a significant amount of tariff increases, which will in turn be passed on to US consumers. So what is my expectation? That will push up the inflation rate, and that is going to make it very difficult for the Fed to keep cutting interest rates further. The other thing is there is no indication that the fiscal deficit is going to be reduced anytime soon. The deficit is currently running at over 6% of GDP, and the debt to GDP ratio is running at about 120%. When I started my career in the early 80s, we were taught that 50% is the safe maximum threshold. We are more than twice that level. And so that means that debt service costs are now using up more of the revenue than even defense spending for the United States. And that's all going to have an impact on inflation.
Take a look at what this reporter asked Powell today and Powell's subsequent response on tariffs.
Great. And just a quick follow-up. Do you, given the recent bout of inflation that we've been through with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many, many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened.
So, Sri, tariffs and inflation, Powell was ambiguous about his response. Do you think he's really not sure about tariffs' impact on inflation, or is he just trying to stay apolitical? Keep in mind that if he makes monetary policy decisions based on expectations of what tariffs could do to inflation, he might be seen as being political.
Right. Here is the problem. And this is what I wrote about in the latest issue on my Substack.
Yes.
And that is that he stays away from the tariff question, because if he wades into it, it may be interpreted as being political. And he has made a big deal of saying that the Federal Reserve is an apolitical entity. Now, but that doesn't make any sense to me. If you are the Federal Reserve chairman, and if you're oriented toward controlling inflation, you need to be aware, or at least have some estimate of how much inflation will go up by. He's correct when he said, in answer to the journalist's question, David, that he's not sure how much it will go up by. That's true. But the impact is not going to be zero. It is going to be something significant. We don't know whether it will be 100% of the tariff increase or 20 or 30% of the tariff increase, which will be passed on. However, if a whole range of foreign countries are going to face tariffs, and they are going to range from anywhere from 25% to 100% of current levels, then it will definitely have a significant impact. And if I were the chairman of the Federal Reserve, rather than just say blithely, I do not know what the impact is going to be, I will delay making the interest rate cut. I will wait for another 3 or 6 months to see what the impact is. We can give him the benefit of the doubt. He doesn't know how much the impact is. I do not know the impact. But then if I would be more careful in waiting to see the impact before actually making the move. And that is where the criticism would lie, as far as I'm concerned.
Well, if we were just to take a look at the CPI index over time, we can take a look at the impact of tariffs from the first Trump presidency. Here's 2007 to 2020. This is COVID. This was not a result of tariffs per se. But if you were just to take a look at the CPI over the course of Trump's last presidency, Obviously, there was energy deflation right before 2020, which probably brought down most of the CPI. But there was not significant inflation when Trump implemented tariffs the first time. Could this time be different?
This time is going to be different because, first of all, you started out with a very low level of tariffs to begin with. So the first time around, the tariffs were not a significant factor, number one. And secondly, COVID came. And during the COVID time, which is also the beginning of COVID, was very much within the Trump administration. And when that happened, the demand for goods just fell off. People did not want to buy anything, and they were afraid of going out to restaurants. There was no foreign travel. The hotel use was low. And all of that contributed also to lower level of inflation. Now you have the COVID practically finished. That's what people think. And at the same time, all of the regular behavior has resumed. And if you increase tariffs with such a background, David, you're going to get a much different result. And also keep in mind, comparing 2020 to today, you're talking about a substantially higher level of fiscal spending and deficit. You're also looking at a monetary base which is significantly increased. And that puts a lot of liquidity in people's hands.
I'd like to flip now over to the civilian unemployment rate, this chart. So the other mandate that the Fed has, as you know, is maximum employment. The Fed has indicated at the last meeting before this one that they are probably prioritizing the unemployment rate as a gauge, because the inflation rate up until the last print was relatively under control. It was going down, not up. Last month was an uptick. What is your outlook then on the unemployment rate? Because you said that the Fed is done cutting rates. Well, if the unemployment rate goes a lot higher, could that change your mind?
It still wouldn't change my mind. And I'll tell you what the reason is. If the unemployment rate goes up and if the inflation rate remains high and you increase the monetary growth, if you cut the interest rates, you are going to have a combination of high unemployment and high inflation. That's what we had during the 1970s. And that is what made inflation repeatedly to come back between 1973 and 1981. And to correct it, you had to have a very severe recession of 1981-82. So the question then becomes, what do you do to fight unemployment? What you have to do is to have job creating incentives on the fiscal side. You need to have a monetary policy which is very predictable, which is rules based, so that everybody knows whether interest rates are going to go up or go down. You encourage private sector investments, therefore hiring more workers, and that's how you bring unemployment rate down. Ben Bernanke, who was the previous Fed chairman during the Lehman crisis, he started something called quantitative easing. And he said, by increasing the monetary base, which he thought was going to be temporary, except that we are stuck with it even today, he said, by increasing the monetary base, I'm putting more cash into the hands of consumers, and I will in turn have more economic growth. That's not how you get economic growth. You get it by productivity improvement. You get it by facilitating it rather than depending on money supply increase to do it. I have a saying in my writings. If you are a plumber and I double the money supply, you're still going to remain a plumber. You're not going to become a nuclear physicist. To go from a plumber to a nuclear physicist, you need education, you need training, and that's the way to do it. So we are living in a world where we started to believe that everything depends on monetary policy. It does not. And that's what I learned in my PhD studies at Columbia University, that you need to be very careful how you use monetary policy. It's a very powerful tool, but it is also a sharp tool.
Not everything depends on monetary policy, but could it depend more on fiscal policy? Suppose the government were to give subsidies to plumbers. All of a sudden, plumbers are now more favored and they have more money and their economy and their sector will boom.
You are right. That is absolutely correct. You can give subsidies to certain areas. You can give subsidies to students so that they may have higher level technical education, especially engineers and scientists that in the United States has a shortage of. You can encourage those studies by providing subsidies. But on the other hand, the way in which subsidies have been handed out over the last 4 years is for people to go to essentially it was family oriented subsidies which did very little to improve productivity and actual production. So I would agree with you that fiscal subsidies can play a good part, important role in bringing down the unemployment rate, but you have to have some offset somewhere else, cut some other spending, or alternately direct the spending only to areas which are oriented to improve productivity of the general population.
I want to go back to the markets one more time because something is still confusing me. If you take a look at the NASDAQ, I don't understand, Sri, why it reacted like this. Just think about it this way. Powell signaled he may pause rate cuts pending more data. You said it's done. Well, isn't that a good sign for the economy? Powell would only cut more if he really believes that there's going to be a recession or massive slowdown or spike in unemployment. He would really need to loosen monetary policy. Things are really bad. Well, the fact that he's not cutting means that things are not really bad. Isn't that positive for risk assets?
It is not positive for risk assets because risk assets have gone up substantially over the last several months of this calendar year. And the reason they have gone up is on the basis of monetary support. So the basic issue here is we need to keep in mind NASDAQ is not the US economy. NASDAQ is not the same as employment. You can have the NASDAQ falling, but it doesn't actually and immediately translate into a similar movement of the overall economy. On the economy side, the interest rate remaining high might eventually bring down the inflation rate, but this is a Fed which probably will not wait until that happens. I've been writing in my reports that something is going to break the way in which fiscal policy and monetary policy are being handled. What does that mean? You have a giant situation like a Lehman Brothers failure, much bigger issue like the bank failure that we had in March of 2023. It becomes an even bigger issue. Commercial real estate failures come to the fore in 2024. Any of that happens, the Fed is going to step in, provide the liquidity, and it will say they are saving the system, but in the process, they will give up on the fight against inflation. So that's been the recurring theme of Fed behavior, and that simply does not promote economic growth.
Do you think there's anything that the Federal Reserve can do next year that could perhaps turn this negative sentiment from equities around? Powell did mention also that they're reducing the size of the balance sheet. Do you think that maybe they will reverse that and start purchasing assets, increase the balance sheet again?
Great questions, David. First, yes, he did talk about quantitative tightening coming to an end, but look at where we are. At the beginning of COVID, at the beginning of 2020, we were at $4 trillion, give or take a few billion. And right now, we are just over $7 trillion in terms of the size. When you haven't cut back to the pre-COVID level of the balance sheet, why are you ending quantitative tightening? Should you not be reducing the balance sheet? The problem is, if they continue with it, they are afraid that they are going to have a cash crunch similar to what we had in September 2019, when the short-term interest rate shot up overnight and the Fed had to stop quantitative tightening. So that is still their issue here. That is still the problem that they are dealing with, that they cannot get over it. So they are stopping. If they were to stop quantitative tightening, I think that would be one more reason why inflation is not going to come down, because the monetary base is simply way too high compared with what the economy needs.
What do you think is going to happen to the 10-year yield or at long end of the curve?
My prediction has been that the 10-year yield, which again, today we are talking about 4.4, 4.5, that it is going to top out at 5%. And if the that is assuming that the tariffs imposed don't go all the way to the maximum level, but they stop short of somewhere close to the midpoint. And if that happens, then you have the 10-year yield go to 5%. But if you have a 100% tariff on China, actually 25% on Canada and Mexico, and 10% on all the other countries, which have been very much in the discussion realm in the Trump team, then I can see the 10-year yield go anywhere from 5.5% to 6%. So we are talking about a significant headwind in terms of the 10-year yield and a headwind for the economy if they were to continue with all the tariffs that they have threatened.
Can debt holders afford 5.5% to 6% yield? What happens to the markets once that happens?
Oh, it crashes the market. That's what a headwind does. Because if you have even 5% 10-year yield, I don't think the equities can take it. I don't think NASDAQ can take it. And that is, you saw a preview of that in this afternoon's session in the markets and what happened then.
Is it possible, Sri, that some corporations that hold treasuries on the balance sheet may actually see a rise in interest income if yields rise?
Absolutely. They are going to benefit from it. You're also going to see high net worth individuals who have a lot of long dated treasuries and mortgage-backed securities on their bonds and their portfolio. They're also going to benefit. But predominantly, the United States is an equity-oriented culture, unlike Europe, which is much more fixed income oriented. So my guess is equities falling due to high interest rates combined with high interest rates and high bond yields is probably net going to be negative for US investors rather than positive for them.
So overall, then, your outlook and your portfolio allocation strategy for 2024, if you were to design a portfolio, what would you prioritize? What would you underweight?
Well,
2025, rather, I misspoke, 2025.
2025, right. Right now, if I were to devise such a portfolio, I would go lower in terms of duration, meaning I would reduce the amount of loss that I incur as interest rates rise and as the 10-year, 30-year yield increase further from current levels. But once something happens, namely there is an indication from President Trump and his top officials that there is not going to be any more tariff hikes, that might turn out to be the high point for the bond yield. And that's when you say increase your exposure in long dated paper. You can benefit from the yields coming down after that.
If we were to take a look at this one more time, this is the Dow Jones. The Dow Jones is interesting because it's now on the 10th day of the longest losing streak since 1978. And of course, there was a massive drop today alongside the NASDAQ and the S&P. So is the market, the equity markets at least, is it signaling a recession, Sri?
The equity market is not signaling a recession yet. That yet is something I would put in italics and underline because it's a crucial term. Because all what you have had is one afternoon session. If you come back next week and we find that the fiscal position and the monetary side become very accommodative, and Powell once again says he's going to do anything possible to prevent a recession from taking place, meaning a different message from what he gave today, you are going to have inflationary pressures perk up, but you will not have a recession with that kind of a setup. And so I will wait a few days to see what happens rather than decide based just on today's developments that a recession is coming.
Okay. Take a look at this question to Powell regarding geopolitical risks.
Do geopolitical risks factor in at all to how you're thinking about energy crises?
So we monitor geopolitical risks really quickly, but, really carefully, rather. But, I would say so far those risks nothing has come out of those risks that really has been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil. now, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Several geopolitical developments in the last few weeks. As you know, the Syrian government was toppled. The war in Ukraine is still ongoing. There hasn't been a resolution yet. China now, trade war with China escalating. Is he right, though, that the U.S. economy is not affected by these geopolitical tensions?
Very good question again, David. And I would agree completely with Powell that the geopolitical risk has not affected the United States significantly. In addition to the problems that you mentioned, I would add the collapse of the French and German governments. You're talking about the two largest economies in Europe.
Yes.
The uncertainty with respect to Canada today with the government.
Yes.
And I would refer to what is happening in Brazil, where the Brazilian real hit a long time low today in its exchange rate. And it is the biggest economy in Latin America. And all of that is happening together. But why is that not a significant, the combination, why is that not significant? Because the United States is large enough to withstand those. Powell is also correct in saying that oil price is the significant external one. As long as you do not have another COVID developing worldwide, you do not have another war comparable to that between Russia and Ukraine, and all you have is oil prices rising, then that oil price rising is going to be the single biggest risk to the U.S. markets. But then as long as that is the case, what he says is quite accurate.
So can you just explain in layman terms, how is oil price rising a risk to the U.S. markets?
In two or three different ways. We are not in the same situation we were in the 1970s, where there had no substitutes, and it was an essential product in production. So when it went up, prices went up, and the economy collapsed into a recession. That was 1973 to 75. Today, we are in much better shape. We have solar energy. We have other ways of substituting for oil. But oil is still significant overall in it. So the two ways in which it is going to work is in pushing up the inflation rate, because energy is a big component in several areas of production. And concomitantly, you're going to have a slowdown in economic growth. And those would be the two ways in which higher oil prices would affect the U.S. economy.
Let's talk about Scott Bessent's 333 policy, focusing on bring the deficit down to 3% of GDP. It's currently at more than negative 6% of GDP. This is the highest level, if you discount COVID, this is the highest level since World War II. What do you think, A, he's going to do about this to bring this down, and B, how will this affect less fiscal stimulus? How will this affect the economy and markets overall?
I would begin by saying good luck to him in achieving his 333 objective, particularly with respect to the 3% deficit, which means the deficit is more than halved from current levels. In order to do that, he will have to essentially deal with a number of what we call sacred cows. He has to deal with Social Security, Medicare, and entitlements, which are automatically going to U.S. residents, are a big part of fiscal spending and of the fiscal deficit. And he has to tackle them. And while you have the Doji, which has involving Elon Musk and Vivek Ramaswamy trying to get that thing done, politically, it is not going to be an easy development. It's not going to be easy. So that part is going to be very difficult to bring it down to the 3% level. Also, keep in mind, a second 3 in the Scott Bessent 333 is 3% economic growth. So if he does that, the reality is he may at least temporarily bring down the growth rate from the 3% level he wants to keep it at. And that, again, may not be politically acceptable. So it's a major challenge.
Okay. So finally, any asset classes that you think will perform well next year in a period of tariffs, rising inflation, a pause in monetary policy easing, what will do well?
Remain globally diversified, because you cannot see where the risk is going to come from, and look at some of the areas which are considered unattractive today and have a presence in some of them, especially emerging markets, which are not thought to be attractive in today's situation, have some presence in it. US is still going to be, it is going to be the prettiest girl in an ugly group, if you want to say that. And so do not leave the United States, have a significant presence. And right now, lower your duration on the fixed income side in the United States, but increase it once you think the yields are higher. And if the stock market takes a very serious hit, then think seriously of increasing your exposure, because the US government always saves the high income equity holder. The poor guy who cannot invest in the stock market is often left to fend for himself. So that is, again, another change in your portfolio that you can make.
Well, speaking of other markets, this is the DXY, huge spike today, especially on the back of higher 10-year yields. Do you think that other currencies will suffer next year relative to the dollar? In other words, short other currencies?
I still anticipate that the US dollar is going to get much stronger. That has been my forecast for the last 6 months. I just strengthened my forecast or fortified my forecast after the Trump election and after he spoke about tariffs being imposed. And if the tariffs are actually imposed in 2025, it's going to cause the dollar to just hit the roof. Today alone, the DXY dollar index went from below 107 to above 108, which is a big move. More than 1% taking place in a single day, and most of it happened within about an hour and a half. And expect more of that to happen in 2025, unless something changes dramatically.
Thank you very much. Excellent analysis, Sri. Appreciate your insights. Where can we learn from you? I mentioned you have a Substack. Where can we find your work?
Yeah, it is Sri-Economics.substack.com, which again, I'm happy to share with you, David. I put my reports out on Twitter, and it is at Sri Global, or people can put themselves on my email list. There is no paywall. They can put themselves on the list, and they will get it automatically. I typically write every Saturday, except for special ones. Next Saturday will be the last one for this year. I take the last Saturday off. And we'll be back again in 2025 to write about various developments.
Yeah, great read. So I encourage everyone to check out Sri's Substack down below, link down below. Thank you very much, Sri. Dr. Komal will speak again next year. Happy holiday season and Happy New Year.
David, great to be with you, and thank you for inviting me. And I wish your audience a Happy New Year as well.
Thank you very much, and thank you for watching. Don't forget to like and subscribe.